But they are now not talking about responding to the same indicators back then that would have told them to be hiking, which you say now, like Rick's yield curve he just told us about, which are telling them to hit the brakes. Is that right?
No doubt about it. So if we take the Fed at face value, what they're telling us the intent is to get to restrictive and then hold there for an indefinite period of time, at least all of this year. That is not the setup that you would expect for a soft landing. It is a potential recession setup and not necessarily one that's short and shallow. Rick mentioned the 10-year to 3-month T-bill spread. You have to go back a long way to see an inversion this deep. And when we have seen inversions this deep, we actually had fairly severe recessions. So my concern, moving further into 2023 is that this restrictive and hold stance until lagging indicators break.
Right.
The Fed's very focused on services sector inflation. That's actually a component of the index of lagging economic indicators that the Conference Board puts out. It means it follows the cycle. It doesn't lead the cycle. It doesn't even move with the cycle. And so if that is what the Fed is focused on before they relent, then I think we've got some storm clouds on the horizon for the business cycle.
And Steve, let's bring you in here. You obviously know very well the models these guys are using, the methods, the approaches that they're watching. There's many of them they're from all different parts of the country. But is there anyone who you hear going, yeah, you know what, I am going to take these signals seriously. I am going to try to think about how to get ahead this time so that we don't over tighten and then cause a deeper recession than is needed?
I mean, I think they're all looking at everything, Kelly, but I think the issue is the emphasis that they give. And the emphasis right now is, as Mike suggested, it's on the labor market and specifically on the service sector, and the extent to which the shortage of labor in the economy right now is going to drive wages, and that will drive inflation. And what the Fed is trying to avoid is to sort of permanently end up in a place where we have higher inflation that's higher than their target. And they believe the way to do that is to bring demand down more in line with labor supply. Kelly, you and I have spoken about this idea that this issue of a labor shortage and labor force growth that's going to be below potential for some, or below what it was for some time, means potential growth could be quite a bit lower than we think it is.
Rick, what would you add?
I think the labor shortage is a very complicated issue, and I think we treat it too superficially. I think there's lots of reasons why 5 to 7 million people aren't back in the workforce, and I think over time they will come back. But I think the government's made it more palatable to have other alternatives. And I don't see how the Fed, erring on the side of overbearing with respect to tightening in the economy, thinks in some way that's going to really bring the skilled labor that's mismatched. We have plenty of unskilled labor that's starting to come into the country, but ultimately the skilled labor for those jobs that we can't fill, the Fed isn't going to make a difference there. I think there's very little doubt they're going to hold tougher because they see they don't want to make, quote unquote, the same mistakes they made in the early 70s. And whenever I hear that, I just pull my eyelashes out. The early 70s, where was China? Where was the global economy? It's a horrible comp. And to think that they're nervous about making a mistake again that they made, 60 years ago, to me makes very little sense.